All right, let's dive into a fascinating topic today, behavioral finance. We're going to explore all the hidden mental traps that can seriously mess with your investments. We'll find out why your brain can actually be your own worst enemy, and more importantly, how you can start to outsmart it. Okay, just picture this for a second. The market is absolutely tanking. You see red everywhere. Panic is setting in, and your gut, your instinct, is just screaming at you to sell everything before it gets any worse. But here's the question. Is that a smart, rational decision, or is that just raw fear talking? That single question is really at the core of everything we're going to talk about today. You see, for the longest time, traditional finance worked on this assumption that we're all these logical, rational investors making choices based on pure data. But then behavioral finance came along and basically said, whoa, not so fast. It finally acknowledged that we're human beings, right? We're driven by psychology, by our emotions, and by all these hidden mental shortcuts called cognitive biases. This is where the clean theory of the market crashes into the messy reality of our own minds. So that really sets up the central conflict, the mind versus the market. In this first part, we're going to see how the very wiring of our brains, the shortcuts that help us get through our day, can actually become our single biggest liability when we're trying to make good financial decisions. Here's the fundamental truth of it all. We are just not the cool, calculated investors we like to think we are. Pioneers like Daniel Kahneman and Amos Tversky completely proved that our choices are constantly being steered by these powerful, unseen psychological forces. And their work didn't just tweak economic theory a little bit, it completely turned it on its head. So let's get into it. Let's unmask 5 of the most common hidden traps that get us. I want you to think of these as invisible puppet strings, pulling on your financial decisions, often in the completely wrong direction, and usually without you even knowing it's happening. First up is loss aversion, and while this one is a biggie, here's how it works. The psychological sting you feel from losing $100 is about twice as powerful as the joy you feel from gaining $100. It's a huge imbalance, and this simple fact has massive consequences for how we behave as investors. Let's take Sarah, for example. She's an investor who bought a stock, and she watched it fall from $50 down to $30. But she just could not bring herself to sell it. Why? Because selling would make that loss feel painfully real. That little voice in her head saying, I've already lost so much. That is loss aversion in action. It completely paralyzed her while the stock just kept on dropping. And this chart just shows it perfectly. I mean, look at the emotional impact. The bar representing the pain of a loss is literally double the size of the bar for the joy of a gain. This imbalance is hardwired right into our brains, and it drives so many poor decisions. Okay, next up is confirmation bias. This is our brain's tendency to act like a really loyal friend, only showing us news and articles and data that agrees with what we already believe. So take John. He was absolutely convinced that renewable energy was the future. So what did he do? He only read glowing positive articles about it, while totally ignoring reports about market challenges. It feels great to be right, but in the world of investing, feeling good can end up being incredibly expensive. And then, of course, there's herd mentality. This is that powerful, almost primal urge to just follow the crowd. We see everyone else piling into some hot new stock, and we feel this intense pressure to jump on board, mostly because we're terrified of missing out. A perfect, very recent example, the whole GameStop frenzy. So many people jumped in right at the peak, only to get hit with huge losses. Following the herd feels safe, but a lot of the time that herd stampedes right off a cliff. Anchoring bias is our tendency to get stuck mentally on the very first number we see. For investors, this anchor is usually the price they paid for a stock. So Mike bought a stock at $100. When it fell down to $60, he absolutely refused to sell. Why? Because his mind was anchored to that initial price. That $100 figure became this emotional reference point that had literally nothing to do with what the stock was actually worth today. And finally, we have overconfidence. After you get a few early wins, it is so easy to feel like you're an investing genius. That's exactly what happened to Alex. He thought he had this special gift for picking stocks. So he dumped most of his money into just one company. He ended up losing 70% of his investment. It was a brutal lesson that a little bit of luck is not the same thing as skill. This is the bias that can turn a hot streak into a complete and total wipeout. Now, these biases aren't just small individual mistakes we make. When millions and millions of people all fall into the same mental traps at the same time, the consequences can be enormous. We're talking about massive market bubbles and absolutely devastating crashes. Let's just look at the dot-com bubble as a perfect example. In the late 90s, herd mentality and overconfidence just completely took over. People were throwing money at any company that had .com in its name, totally ignoring basic business fundamentals. The mania just built and built until 1999, and then, as it always does, the bubble burst, leading to a truly historic crash. And the scale of that fallout was just staggering. $5 trillion. That's the amount of wealth that just evaporated into thin air. It's a number that really shows you just how destructive our collective psychology can be when we let it run wild. Okay, so that was all the bad news. The good news is we can absolutely fight back. We can build a toolkit full of rational strategies to protect ourselves from our own worst instincts. So let's look at some practical tools you can start using, like today. Probably the most powerful tool you have is a written investment plan. This is your personal constitution for investing. By defining your goals, your risk tolerance, and setting up crystal clear rules for buying and selling before you're in the middle of a panic, you build these guardrails that keep your emotions from taking the driver's seat. Next up, diversification. This is the ultimate antidote to that overconfidence bias. By spreading your investments across different kinds of assets, stocks, bonds, real estate, you make sure that one bad decision or even just one unlucky break in a single area won't sink your entire portfolio. And to round out your toolkit, here are a few more really effective strategies. First, to fight that confirmation bias, make it a habit to actually seek out opinions that challenge your own. Next, to combat loss aversion, you can use automatic stop-loss orders. They take the emotion right out of the decision to sell. And finally, think about working with an advisor or even just an accountability partner to give you that crucial, objective perspective when you need it the most. But look, tools are only one part of the solution. The real goal here is to cultivate a smarter mindset, to develop the kind of long-term habits that really form the foundation of successful investing. Ultimately, a successful foundation is really built on 3 key habits. First, learn to embrace long-term thinking. It makes all the short-term market noise a lot less terrifying. Second, practice recognizing your emotions, but without letting them dictate your actions. And finally, just never stop learning. The more you understand about finance and about your own psychology, the better an investor you're going to become. And that really brings us to our final thought. As you look at your own investments, at your own decision-making process, I really want you to ask yourself this question. Which one of these hidden traps might be at work in your portfolio right now? Because just recognizing the trap is the very first and most important step to disarming it. Thanks for tuning in.